All right, next chapter we want to talk about is cash. And this is kind of an important chapter. It's a long chapter too, kind of. Cash is important because without it, businesses cannot survive. The number one reason why companies fail is because they lack adequate financing, cash flow. And so cash and cash flow are the lifeblood of any company. Without it, they can't exist. So it behooves companies to be good stewards of their money and to make sure that they manage money, cash, wisely. So this screen asks the question, how much cash should a business have? Well, certainly enough to keep them in business, obviously. So the main point here is that you keep cash on hand just enough to operate, and any additional cash you have, you don't want it sitting around idly in a bank account, in a checking account, or even a savings account, because they don't pay squat. So good cash management means that you figure out how much cash you need to operate, and you invest the rest and try to earn a decent return on these investments. And so it's a daily process. You have to figure out, forecast how much cash you're going to get in, how much cash you have to pay out, and if you have excess, you invest the excess. If you don't have enough cash and you've got something coming up that you've got to take care of, then you might need to tap into other sources. You might have to sell some marketable securities. You might have to look at other financing options. So it's a constant battle. It's not something that just happens once a month. This is a daily occurrence for companies. Now, how do we value? What valuation standard do we use in determining the value of our financial assets? Well, for cash, and this thing called cash equivalents, which we'll talk about here in a minute, the value is its face value. A $10 bill is worth $10. A cash equivalent, whatever it's worth, or whatever it says it's worth, that's the face amount. That's what it's worth. Now, for something called short-term investments, which we'll again talk about shortly, the basis for valuation is fair market value. Well, I thought everything was you're probably asking yourself, I thought everything was based upon the cost principle. Well, almost everything. In the case of investments, marketable securities, GAAP requires valuation to be made at its fair market value. Receivables, accounts receivable, selling on credit. We don't list the gross amount of our accounts receivable as the value on the balance sheet. We list something called the net realizable value. Well, what is that? Well, just realize that if your credit policy is optimal, you're not going to collect from everybody you sell to. Now, that may just really kind of be counterintuitive, but think about it. What are you doing if you're only selling to customers who you know will pay you? Well, you're missing all those that there's a very good chance they'll pay you. You're just not guaranteed a payment. So you're missing quite a few sales. I mean, this is not to say that you just open the door and sell to anybody and everybody, because that's not a good idea either. But at some point, it's okay to lose 2% of your sales to uncollectability, because you're expanding your customer base. So here we have net realizable value, which takes the gross amount and tries to predict the amount that will not be collectible. And there's several ways we can do this, which we'll talk about. And so we write down the amount we believe to be uncollectible to come up with the net realizable value. Now, cash is what you think: coins, paper money, checks, money orders, traveler's checks, bank credit card sales, you name it. Anything the bank will accept. Well, what about cash equivalents? Well, again, if you don't want to keep too much cash in the bank, and so if you have excess cash, there are these things, these investment vehicles that are very short-term in nature, 90 days or less, and that's kind of the standard. If the maturity date is 90 days or less, it's considered a cash equivalent. These are relatively safe investments, such that the face value or the value of the cash equivalent is considered the same as cash. In other words, they're not volatile. They're almost guaranteed to pay. Unless something really, really strange happens. So examples of cash equivalents are treasury bills. These are backed by the U.S. government. Commercial paper. These are short-term notes issued by large companies. And let's see, I think there's one more. Oh, money market funds. So you're out there in the stock market and you're investing in diversified stocks. a wide range of stocks. Now, what about restricted cash? Well, what is restricted cash? Well, let me give you an example. Let's say you have a line of credit with the bank, and so you owe them money on a loan, and part of their loan agreement says that you must have a certain amount of money that you have to hold back and must have in reserve at all times. Well, that's money you can't use for other purposes, and so that's considered restricted cash, and you have to report it as such in your balance sheet, and thus it's segregated from your regular cash balance. What about lines of credit? Do we list that as cash? No. Lines of credit are things that are available to you, but you haven't borrowed yet. So essentially what you're going to do, usually you're going to see some sort of, where you see this in financial information is in the management's notes, usually management discussion and analysis or something like that. After the financial statements is where you'll see where they talk about their available lines of credit, but you don't list it anywhere in the financial statements themselves, the 4 financial statements, and certainly not in cash. All right, so here, what they talk about is some of the basic objectives of good cash management. Accurately account for cash. Provide an accurate accounting of cash receipts, cash disbursements, and cash balances. Prevent theft and fraud. What do you think? Well, first of all, who do you think is the number one perpetrator of theft and fraud on a business? Is it an outsider or an insider? Well, your instincts might say it's an outsider, but it's actually an insider. I've seen this before, instances of small companies who, hire people to help them manage the company, and a lot of them accountants, unfortunately. And they end up stealing from the company. So, sometimes your own employees are your worst enemy at keeping assets safe, especially cash. That's the number one desired asset that insider thieves want, because it's so readily available to convert. I mean, it's very easy to convert, right? Even if you have a check. And so anyway, you really have to create some controls so that you prevent this theft and fraud, especially from insiders. Certainly outsiders as well. You have to anticipate needs for borrowing. We kind of talked about that before, and assure the availability of adequate amounts of cash for conducting business operations. So that's just good business cash planning. It starts with determining how much cash you're going to get in, how much cash you're going to have to pay out, and if there's excess, you don't need to borrow, but if there's a shortfall, you have to have the means, the wherewithal to go and borrow those funds somewhere. And like I said, prevent unnecessarily large amounts of idle cash. You don't want cash sitting around in your checking account. Now, some good tenets of internal controls for cash, and again, internal controls are meant for more than just cash. I mean, it's a company-wide thing. I mean, it's a good idea if you have, let's say you have inventory that you keep in an open yard, and I don't mean like in front of a house or the back of a house. I mean like, you have your building, and then there's a yard where you store stuff, and you keep heavy duty inventory out there. Let's say it's pipe. Well, it's a good idea probably to have fencing, barbed wire fencing, maybe electrical, and maybe some walking security at night, maybe some dogs, whatever. That has nothing to do with cash, but that's certainly an internal control over inventory. So there's more to internal control than just cash, but you definitely have to have good internal controls over cash, because that's the number one target for thieves, inside and out. And so you want to segregate people who authorize the disbursement of cash as well as the receipt of cash from those with custody of the cash. And you want to segregate both of those individuals or departments from those who record the cash. So that takes at least 3 people right there, or 3 departments. Very important. This is a problem for small businesses. They don't have enough employees to segregate these duties. But somehow, some way, it's got to be done. Prepare a cash budget. That's almost a daily routine. This helps you figure out whether or not you have enough money to operate for the day, the half week, the week, the month. I mean, budgets are continuous. Prepare a control listing of cash receipts at the time and place the money is received. I mean, you just need to keep a list of cash receipts is what it boils down to. Require daily deposits. You don't want deposits sitting around, because they can get lost, they can get stolen, all kinds of things, bad things. Plus, it's bad cash flow management. Get the money in ASAP. Don't let it sit around. Make all payments by check. Well, I mean, in this day and time, there's so much done with ACH, wire transfer, basically, electronic type transfers. I don't know how much this tenet proves to be true anymore, but certainly to the extent you don't pay by electronic means, pay by check. But the main thing is you've got to have a paper trail. And so checks certainly do that. You lose some of that when you get into these electronic type transactions. I mean, there's ways to create a paper trail for electronic transactions, but it's a little more difficult. Require that every expenditure be verified before payment. Promptly reconcile bank statements. We'll talk more about reconciling bank statements. They make a big deal about cash over insured in a lot of these books, and I don't want to spend a lot of time, but just kind of note here that, if you're a business that deals in cash, such as where you have cash registers and you have each employee that works a cash register has a drawer, sometimes money disappears for whatever reason. It may not be, it may be purely innocent. The person working a register simply gives back, refunds too much money to a customer, that sort of thing. So, having a shortage is not due necessarily to evil intent, although it's certainly worth something looking at if you have an employee who continuously has a registered drawer that's shorted. But how do we deal with that when you do have that sort of thing, a cash shortage? Well, we have this contra asset account called cash over and short, and in this case we have out of a cash drawer or cash register, total cash sales on a certain day were $4,500. However, cash receipts were counted and totaled at only $4,485. So how do we handle that? Well, we create this contra account called cash over and short. We debit it and we credit So pretty easy. It's not that big of a deal. Reconciling a bank statement. Hopefully you know how to do this from personal circumstance. If you get a paper statement, which hardly anybody ever does anymore, I don't need to. I can hop on my smartphone really anywhere I am and find out what my balance is, what's cleared, things like that. But that's personal. This is business. And so we do things a little differently here because of the volume of inflow and outflow, and you've got people handling money who you may trust but you shouldn't. Again, one of your biggest threat to stealing cash is insiders, employees. So always keep that in mind. And so one of the tenets of good cash management is to reconcile the bank statement at least once a month. And so the bank statement reconciliation explains the difference between cash reported on your bank statement. So we call that the bank, and the cash balance in the depositors, that be you, accounting records. Okay, so that's your book. So we're comparing bank versus book balances. So this bank statement provides information for reconciling journal entries. When you have a difference between bank balance and book balance, you may have to record journal entries to reconcile the two. And so, what are some of these things that cause bank balance to be different from book balance? Well, one would be what they call deposits in transit. You get a bank statement that gives you the balance at the end of the month. Let's say on the last day of the month you made a deposit that hasn't been included. That's considered a deposit in transit. And so you have to add that to the balance per the bank statement. Well, what about you've written some checks and they haven't cleared? Well, those are considered outstanding checks and they have to be subtracted from the bank balance. And then you might have other bank adjustments that they talk about. You might have service charges. You might have, for handling, you might have a monthly fee. Nobody does anymore, or hardly ever does, but if you have a service fee of any sort, you're going to have to subtract that. If you have any interest earned, as little as banks pay on interest in checking accounts, that would be an add to the bank balance. If you had a check bounce and they charge you an NSF fee, that's going to be a negative. And so you adjust your bank balance for deposits in transit, outstanding checks, and other bank adjustments to come up with the balance, adjusted balance per bank. And then you compare it with the balance per depositor. Here you might add deposits to the bank you didn't know about. Let's say you got a wire transfer in that you weren't aware of. That would be something you would add to your balance, book balance. You get a service charge. You're going to subtract that there. NSF check. Actually, the service charge and NSF checks are already going to be taken out of the balance per bank. So those bank adjustments are already going to be there. Those are things you're going to have to do on your side, the book side. What type of book adjustments might you have to make? Well, let's say you look at a check and realize that you transcribed the amount. It was an $89 check and you had it at $98 on your books, but it cleared as 89. Well, you've taken too much out of your account, so you've got to put in $9 more to your bank balance. So you have to add that $9 difference. So anyway, you have all these things that you have to consider in coming up with the adjusted book balance, and then you're going to compare adjusted bank balance to the adjusted book balance. So they give you this example here. Bank statement for this company is $5,000.17. Cash ledger account on that date shows a balance of $4262.83. You have 4 outstanding checks totaling $717.75. That's going to reduce the bank balance. A 410.90 deposit made after banking hours does not appear in the bank statement, so you've got to add that to the bank balance. On July 30, the bank returned J.B. Ball's NSF check for $50.25 received as payment of an account receivable. That's going to be something you have to add back into your book, because when you got the check, you added the cash and you credited that particular customer's account. So you subtracted or credited the account receivable from that customer. So you got to add that back in and reduce your book balance by $50.25. The bank statement showed $24.74 interest earned on a bank balance for the month of July, so you're going to add that to the book. The bank collected non-interest bearing note of $500 and charged a $5 collection fee. Okay, so that's $500 you didn't know about. You're going to add that to your book, and then the $5 collection fee, you're going to have some sort of bank fee that you're going to have to recognize in your book. Anyway, it's a subtraction from your book balance. Check 893 for phone expenses cleared the bank for 85, but was erroneously recorded in our books at 58. So there you've got a $27 difference. Here you wrote it for more than what's recorded in the books by 27. So what are you going to do to your books? Well, in this case, you're going to reduce it by 27. And then on top of all that, you have a bank service charge of $12 that would subtract or decrease your book balance. And so here's what that looks like, the reconciliation. You add the 410.90, you deduct the outstanding checks. In this particular example, you don't have any adjustments to make on the bank balance side, and so your adjusted cash balance, bank balance, is $46.93.32. Now the balance per deposited records, that's your starting point. You're going to add your note receivable that you collected and your interest earned, and then you're going to deduct the collection fee of $5, the NSF check, service charge, and the error on the check stub, $893, and hopefully, and so you come up with an adjusted book balance, and hopefully that equals the adjusted bank balance. And in this case it does. Well, okay, that's great. They reconcile. Are we through? Well, no. We have to take all these things here plus here and add them to our accounting records. And so we have to add the $500 into cash and note what it's for. Credit the customer. We have to debit cash here and recognize interest revenue. We have to recognize a collection fee here. So we have an expense here. That's a reduction of cash. Reduction of cash here and put back in the accounts receivable. Another expense here that we have to deal with reduces cash, so that's your credit. And then here we have to reduce cash and increase whatever expense that was. So let's look at that. All right, so increase in cash here for our note receivable and interest revenue, and then reduction of cash for these things. Bank service charge $1,700. That's the 12 monthly service fee plus the $5 collection fee. Adding back in the account receivable, and since that was a reduction of cash because it wasn't collected, you have to reduce your cash balance, and then we have to increase our telephone expense, and of course reduce our cash balance by the transcription amount. Okay, so that's kind of important to know. How to reconcile a bank statement. Briefly, short-term investments. Again, if you're not going to invest, let's say you want to invest in longer-term investments than what we call these cash equivalents. Okay, so marketable securities are different from cash equivalents because cash equivalents have a maturity date of 90 days or less. Marketable securities have a maturity date either open-ended or longer than 90 days. Okay. What's the difference return-wise? Well, you're going to get a higher return maybe for marketable securities than you would for cash equivalents. The downside of that is they may not be quite as liquid. They're certainly not as liquid as cash, but you may be subject to more fees than you would with cash equivalents. Can you sell them? Oh, absolutely. And so they are almost as liquid as cash, but not quite. So if you have these marketable securities, you're certainly going to have to put them on the books initially at their cost. But if you recall, when we were talking about how we value certain types of assets, we have to list these initially at the price we bought them. So that's our cost. In this case, we buy 4,000 shares of Coca-Cola Company at 48.98 per share, plus a brokerage commission of $80. And so we're going to add the cost of buying this, the brokerage commission, as well as the cost of the stock in determining our cost of these marketable securities. And so total is $196,000. Okay, but remember, we report these at market, so the market value of stock, public stock, fluctuates, goes up and down. And so let's say at the end of the period, well, before we get to that, let's get to this. Let's say we get a dividend from Coca-Cola, and so that's going to be called dividend revenue. And remember, revenue is a credit balance. And of course, our debit's going to be to cash, since this is a cash dividend. So that's not a big deal. But let's say we sell the stock here 18 days later. I mean, you can do that. The one thing about marketable securities, some of them have maturity dates. Stock does not. Okay, so you can buy and sell stock at any point. The cash equivalent things are more like what you would see as a CD, where you have to leave it in for a certain time. But stock, you can buy and sell every day if you want. So here, we sell 500 shares for $50.04 less a brokerage commission, and so we're going to reduce our proceeds by the amount of the brokerage commission. And so sales proceeds are $25,000. Our cost basis is $24,500, and so the gain on the sale is $500. Well, what if we kept this all the way up to December 31st? I don't know if they show this or not. Well, here's an example of what happens if we sell the shares or some of the shares for less than what we purchased them for. And so here we're selling them for less than what we purchased them for. And so we've got a loss on the sale of the investment. So here, finally, Foster's remaining shares of capital stock have a current market value of $47,000. Prior to any adjustment, the company's marketable securities account has a balance of $49,000. Well, the current market value at the end of the month, well, end of year, they held them for 1 month, right, is $49,000. The book value is, or the cost is $49,000 of these securities. The market value at the end of the year is $47,000, and so they're going to have to recognize an unrealized holding loss on the investments of $2,000. And of course, that's going to come out of the marketable securities account, so that's your credit. And notice it says unrealized loss. They still have some of these shares of stock. 1,000 shares. And so this is how the balance sheet would look on December 31st. They would parenthetically mention that the cost of these marketable securities were $49,000, and the market value at December 31 was only $47,000, and that's the amount that they carry over into the numbers section. So the question is, well, where do we show this unrealized holding loss? Well, it's not in the balance sheet, or not in the income statement as you would think. It actually goes against stockholders' equity, and so it's in the balance sheet, not the income statement. So that's a little different. All right. Okay, I'm going to stop here and pick up in the next video with accounts receivable.